So you might have noticed we did something a little different this month with the videos. Instead of doing one long video, I decided to do a series of shorter videos that sort of go together but also delve into more detail into each topic, which you might find interesting. That way you can sort of select your own content and not be wading through one long video that you may not care about most of what is in that video. So I hope you like the new content, or the new format, sorry. So the first thing I want to talk about is the U.S. economy. As we talked about in the video and in the article about the U.S. update, the U.S. economy is flashing us warning signs. I'm showing you the yield curve for Treasury bonds, and that's one of the biggest warning signs because it's inverted right now. Economists use this as a key metric for determining whether the United States is likely to enter into a recession because historically it's been very accurate. It's been our most accurate forecaster of an economic recession in the United States. So nobody's panicking yet, but it's the fact that it's now trading in an inverted relationship is a huge cause for concern. The U.S. economy is slowing. And honestly, in my mind, there's pretty much no doubt that it's slowing. The U.S. economy has been acting and firing on all cylinders, but that's in part because it's had a massive government stimulus. The government enacted tax breaks and tax incentives, which while simultaneously spending more. So that is effectively giving the U.S. economy a shot of adrenaline in the arm. The problem is that spending comes to an end and eventually the adrenaline wears off, and that's what we're seeing. So I've talked about it more in the U.S. update, but suffice it to say, I believe there's substantial evidence that the U.S. economy is slowing. Now, whether we're going to get into an actual recession or not, I'm really not sure. I don't know, and I'm not going to make a prediction on that at this time. But I'm concerned about it because that obviously affects the demand for oil. It also affects budgets and everything else and how conservative creditors will be with lending shale oil money. And so it has a dramatic effect on our industry. And in this month's edition, the article I really enjoyed writing and the video I enjoyed creating was the article about U.S.-Chinese relations. Obviously, a trade dispute and a trade war has a negative impact on economies. At the very least, it creates uncertainty, which markets don't like and which businesses don't like. I actually think that the current dispute between the United States and China has really very little to do with trade and a lot to do with China challenging U.S. global hegemony and a battle for the future. So I firmly believe that there's nothing more important right now in terms of the economic and security and the peace and prosperity of the world than the trade dispute between the U.S. and China and all the implications of it. So I highly encourage you to look at that. I'm not going to go into detail here because it sort of stands on its own. The next thing I want to talk about is OPEC. As you may remember, OPEC agreed to production cuts, and we're finally getting some results of those cuts, and they're doing a phenomenal job. In January, they removed approximately 800,000 barrels per day from the market, with a total of approximately 30.81 million barrels per day. In February, they cut it even more. According to a Reuters survey, OPEC production has now reached a 4-year low, and the group's at about 101% compliance. So I'm showing you a table of their compliance, and you can tell from it, clearly there's oil coming off the market involuntarily, Venezuela and Iran, but there's a lot coming off voluntarily. So that effort is certainly helping to rebalance markets, which is why we've seen some big inventory draws and things like that. And I'm also showing you, or now I'm showing you, the OPEC production compared to its 12-month average, and you can see it's pretty substantially lower than it has been in the past. Where does all this go? So I truly believe that Saudi Arabia wants to see $70 a barrel oil, and they're not going to be satisfied until they do. Simply put, Saudi Arabia has an ambitious social and economic program because it sees the writing on the wall. It realizes, first of all, yes, we're moving to clean energy and all of that, and that's going to have an impact for the demand for their key and really only product. But the bigger issue, I believe, is that they're trying to see that there's recoverable reserves all around the world. So they're losing their power in that sense, and they're losing their ability to dictate market conditions over time. And so I believe Saudi Arabia learned from what happened in October, November. They believed, I believe, that markets were firmly in balance and that everything was going to be okay and they had done everything they needed to do, well, they saw how quickly markets were out of balance again and how quickly we went from 70 a barrel to, well, we touched less than 50 for like 5 seconds. But basically, that we had $50 a barrel oil all of a sudden again, and that scared them, because I also believe that Saudi Arabia is well aware that the next coalition in terms of recruiting members outside of OPEC is not going to be that easy to build. As we discussed in the OPEC update, there was some resistance in Russia to even agreeing to another production cut, and Mr. Putin has been urged by several people to exit the agreement because they believe that it's basically playing into U.S. hands to the detriment of Russia. I don't think that's true. I think that a collapse in the oil price is substantially worse for Russia than it is for the United States. But either way, I think Saudi Arabia knows that this time they're not just going to have to cut, they're going to have to cut deep. And by that I mean, I think Saudi Arabia sees U.S. inventories, and that's going to be the metrics. The real reality is they want a substantial inventory draw so that there is time for the markets to basically be craving oil. So I'm confident that they'll continue. I don't know if they'll extend it beyond their June meeting, but I think that what they have done has gone a long way towards rebalance. We just have to let it play out, and we have to see how things go once we start this summer driving season. In the U.S., so let's talk about U.S. oil production. The first thing I'm showing you is the rig count. As you note, it's been declining. It's been declining pretty substantially, and that declination has honestly accelerated since January. And there's some problems. One of the things I think that is the most concerning to me, and it's funny because at first I wasn't that worried about it. So there's an article in the Wall Street Journal about the parent-child relationship as it relates to oil wells. So basically the story is this. Shell Oil decided that the way to effectively and cost-effectively drill wells was to drill newer wells close to existing wells. The existing wells, the parent, the wells close to it are the children, right? Makes sense. And they swore up and down that their, geologists and engineers and everybody else said, hey, we're going to get the same production out of those wells, and we'll save a whole bunch of money because we'll save all these logistics costs and everything else. Fast forward, the results are starting to come in, and they're overwhelmingly negative. And that the amount recovered from the child wells, is substantially lower than the parent well. And worse, what they found is that when you blast through deep rock, you're competing for scarce resources, and it's now affecting the production from the parent well. So they've created a real problem for themselves. But why am I concerned about this? Why do I think that this is a huge issue? Well, first of all, in 2016, the federal government told lenders, banks, that they had to tighten their credit standards for oil companies because they were concerned about it. So banks did that. They responded to the government's regulatory authority and tightened the credit terms pretty substantially. So all of a sudden you have all these shell wells who have now overstated the value of their reserves to their creditors, and you're going to have creditors starting to tighten the credit pretty substantially. And they may even have to write off billions of dollars off their books. So their assets are less, so there's less to lend against. So creditors are going to tighten terms at a simultaneous time where shell companies are now going to have to spend more money to drill a well. So I think you could actually see a pretty substantial slowing in North American drilling as a result of that. So other concerns about North America, obviously the economy that we talked about, the trade war that we talked about, and smaller operators have almost universally slashed their budgets. Frankly, they're just conserving capital, so that makes sense. But we do have some good news, and so I don't want to overwhelm us with bad news. The good news being both Exxon and Chevron have said that they're increasing their investment. They're kind of going against the grain, particularly in the Permian. Pemex has indicated that they're going to increase their budget, which they needed to because they've kind of gone years without doing it, and so they have some actual problems they're starting to develop. And inventories are cooperating. Inventories took a huge drawdown a couple of weeks ago. They did not have such a good result this past week, but overall, we don't expect huge draws right now. When we expect to see draws is really beginning when the summer driving season starts and kind of right the lead up to it. So that all speaks well to oil coming back in balance. And frankly, this was a little bit predicted. I think if you go back and look at our December video that we did, this was, and my analysis then, I told you guys that I thought we'd slow down. But the good news is I don't think it's going to be a sustained slowdown. And overall, I'm actually more confident about the health of the market. So the next thing I'm showing you is the current futures curve. If you'll note, we are firmly in backwardation. Remember, backwardation is go. We're about $1 into backwardation, which obviously we'd like to see more, but I think that there's just not enough data right now to support substantially more backwardation. I think that as long as Saudi Arabia continues the cuts, and I say Saudi Arabia because it really is Saudi Arabia. Yes, they have some people helping them, but let's be clear. The people bearing the brunt of this are our friends, the Sauds. So, you know, when you add all of that together, when you add that the oil minister of Saudi Arabia said that he is aware of $11 trillion, not billion, trillion dollars of investment that's getting ready to hit, that's on the sidelines right now, but it is planned for oil. I think that's overall positive. I think as long as OPEC continues to do what they're said they were going to do, which I think they will, oil markets will rebalance, and I think we may even get those deep inventory draws that we needed to rebalance them for the foreseeable future. So the downturn that we're experiencing, which there is a little bit of one, that's not only the informal data I've gotten, but what all the numbers show us, I think will be fairly short-lived, because I think that once inventories hit below a certain number, you'll see a substantial amount of investment. So I hope you enjoyed this video. I hope you enjoyed the way we did the format this month, and please feel free, if you have any comments or questions, to contact me. If you really like this video, please hit the like button on YouTube. It helps us a lot. And as always, thank you for your business, thank you for your friendship, and thank you for your support. Let us know if there's anything we can do for you. Take care.